2025 is set to be one of the most volatile years in recent market history. And while the market may indeed continue to climb higher and higher over the coming year, that will likely come at the cost of sharp pullbacks, extreme spikes in volatility, and severe divergences in performance across different asset classes along the way. In other words, 2025 will be a rare opportunity to make money both ways in the markets for those who are prepared. So why is this year looking like it is set for such extreme volatility? First off, we have positioning across the market. Cash versus equity exposure from major players, from mutual funds to institutions, is heavily leaning towards equity exposure and very light on cash. You can see from this chart, mutual fund cash levels are near the lowest level in data history going back to 2015. Cash as a percentage of assets under management is almost at an all-time low. We are also seeing cash levels that are reported in Bank of America's Global Fund Manager Survey well below average, also near an all-time low. The reality is that tops form in markets when everybody who is going to buy has already bought. Therefore, the positioning becomes extreme towards the long end. Once all of the buying has occurred, the only market action possible is selling. So a top forms, buyers turn into sellers, a downturn starts to emerge, and it doesn't end until all potential sellers have already sold. Then the bottom forms once all those sellers have sold, and the only thing left to do for potential market participants is to buy. In other words, when positioning becomes extreme, that signals the end of that short-term cycle. And in terms of cash versus equities, it looks like we are there right now. The second thing happening in 2025 that will be feeding volatility is the flip from easing financial conditions into tightening financial conditions. Now, if you've been paying attention to the federal funds rate, then you know that right now we are in a cycle of cutting. The Fed raised rates in order to deal with the inflation they unleashed from their money printing, held rates steady throughout 2023 and 2024, and then late 2024 started cutting rates again. Which means you're probably thinking, well, how in the world are we going to be seeing tighter financial conditions if we are in a cutting cycle? Normally, you would be right about that, but this time it is more about expectations, because the amount that they have actually cut so far is not enough to actually ease financial conditions. Most of the easing that has happened was due to the expectations of further cutting by the Fed. However, if you take a look at 10-year yields, you can see the market does not believe the Federal Reserve. And in fact, ever since the Fed started cutting, free market interest rates have done almost nothing but rise. This is true of the 20-year as well as the 30-year. This is because the Fed never finished its fight against inflation and started cutting anyway in order to bail out the government. The government has to roll over 30% of its debt this year. 30% of the national debt is maturing during 2025. That's all debt that they have to pay back. They have to borrow new debt in order to do that. That's why the Federal Reserve is lowering interest rates. The fact is that this is going to cause inflation. It means more printing, more borrowing, more spending. And when the federal government unleashes that inflation on the economy, it pushes prices up, which means lenders in the free market, in the private economy that can protect themselves from inflation and need to, will do so. This means you and I are going to be paying higher prices and higher interest rates for debt, despite the fact that the Federal Reserve is cutting rates. In fact, it's not even despite of the fact, it's because of it. Them cutting rates means the government gets to borrow more money for cheaper, means they get to spend more money into existence, means your prices go up. Which means that even though the Federal Reserve is cutting rates, because of inflation, they might stop that soon. And either way, we're going to have tighter financial conditions from higher prices and higher rates in the private economy. The way this is going to play out in the market is extreme bursts of volatility where you have very quick sell-offs and then maybe even just as quick recoveries. Recently, we've had all of the market performance concentrated in just a handful of stocks, and extremely uncorrelated performance across a variety of sectors. This will escalate into 2025, and it means that 2025 is probably going to be one of the best years in recent history to make money if you're prepared to do it. That's why in just 2 weeks, I'm going to be hosting an asymmetric trading masterclass where I'm going to teach you how to profit off of the things happening in the market right now. If you're interested in participating, I want you to write this date down. January 23rd at 7 p.m. Eastern Time. I'm going to be hosting a live masterclass where I'm going to be covering what I consider to be one of the best kept secrets in all of finance. the asymmetric trade. For years, I've been using these kind of trades to take home massive returns in my own personal account. And recently, I've been helping a small group of people do the same. So far, the feedback with this program has been phenomenal. People have been emailing me about taking home a few big wins of their own over the last few months. Like Dan said, "Joe, thank you for my first 10-bagger. 1,175% to be exact." Or Charles said, "Thanks a bunch, Joe. First 10-bagger for me." And Rodney emailed me saying, "Awesome call. I left my phone at the office last night, went back in to check, and it had gone higher, and I closed out my position with a 1,600% gain." And while I do want to caution you, these trades can carry higher risk. I'm going to show you everything I know during this masterclass. We're going to cover things like how much of your portfolio you should be allocating to this strategy, how to mitigate your risk on these types of trades, and how to target each trade for maximum profit. If that sounds like something you'd be interested in learning as we enter 2025, the year of volatility, go ahead and click on the link in the description below and enter your email. I look forward to seeing you there. Now, earlier I mentioned the record low cash positioning with mutual funds and money managers. But if you've been paying attention to money market funds recently, you're probably looking at that and thinking, well, cash balances in money market funds are at an all-time high, so isn't there a lot of cash on the sidelines? And while you are correct that there is a record high amount of cash in money market funds, that doesn't represent cash on the sidelines. Here's why. Here is a chart of money market funds, and you can see as of Q3 2024, there are about $6.8 trillion in money market funds. This chart just seems to go up and to the right, and no matter what, the cash balances in money market funds just continues to grow. If you look at what money market funds did from 2018 through Q2 of 2020, did nothing but go up. You would have thought that this represented a bunch of cash on the sidelines. But if we take a look at what happened in the stock market during that time, the stock market had a severe crash, wiping out trillions of dollars of value. So all this supposed cash on the sidelines did nothing to stop the 2020 crash. Similarly, money market fund balances continued to grow through 2021 and 2022 and 2023. And all that extra cash in the system did nothing to stop the bear market in the stock market that started at the beginning of 2022 and ended towards the end of 2022. All of this cash on the sidelines was allegedly never put to work, which means that even though we are looking at another record high in money market fund balances, this doesn't necessarily represent cash on the sidelines and won't necessarily step into the market to take advantage of any significant, severe, or swift drawdown. So why is that? Well, quite simply, this represents collateral, not cash. In other words, this money is already invested in the market, much of it with leverage, which means the money market balances that you're seeing here are collateral in case of a sell-off. It's not dry powder that is waiting to be deployed after a pullback. It's a safety net for an overinvested and an over-leveraged positioning across the stock market. And the final piece of the puzzle that is going to be increasing volatility into the 2025 calendar year is changes to monetary and fiscal policy. The reverse repo facility has recently had a change that will drain the balance down to zero. Zooming in, we can see at year end on December 31st, there was a big spike in the balance at the reverse repo facility, but this is year end. And you can see there were little spikes in the reverse repo facility even before this facility was being used by the Federal Reserve for financial system liquidity management. So this little spike we're seeing towards the end of the year here is rapidly going to go away over the following few market days, and this facility will approach zero, and there will no longer be excess liquidity here. This is because most government borrowing is done with T-bills, in other words, debt that needs to be paid back in under 1 year. T-bills are a direct competitor to the money inside of the reverse repo facility. And now that the reverse repo facility does not pay a premium over the lower end of the federal funds rate, that cash is sucked out into T-bills. But like we mentioned earlier, 30% of the national debt is maturing this year and will need to be rolled over. There is no longer trillions of dollars inside of the reverse repo facility for the Treasury to draw on by issuing bills, which means much of this debt will have to be rolled over and refinanced into longer term debt. This means we're likely to see an end coming to quantitative tightening, and the Federal Reserve will allow its balance sheet to start moving sideways and will continually roll over any of the debt that matures here and not let it just be paid off and that money cease to exist. In other words, we have the Treasury refinancing a bunch of short-term debt into longer-term debt. We have the Federal Reserve ending quantitative tightening as a result of the reverse repo facility hitting zero. And we also have the wild card of Janet Yellen looking like she's going to try and drain the Treasury General account before the inauguration happens. All these together mean the Treasury and the Federal Reserve are going to have a big challenge ahead of them in order to deal with the monster of the national debt that needs to be rolled over and liquidity concerns in the financial system, all while making sure you don't just print a bunch of new money in order to tip over into a resurgence of inflation yet again. This is like threading a microscopic needle and will likely result in policy errors that will cause, you guessed it, extreme bouts of volatility across the market. But don't be scared, be prepared. I, for one, am very excited. This should present some massive opportunities to make money both ways in the markets, and I can't wait. And don't forget, if you'd like to join me for the Asymmetric Trading Masterclass, click on the link in the description below, sign up, and I'll see you there. Thanks so much for watching. Have a great day.